let's start with interest rates. In this low interest rate environment, how do you see this? What implications does it mean for the economy?
Well, the Fed is really, in my opinion, holding the market up. I mean, we're long and we keep a big hedge on. Day like this, we make money. But it is concerning that, the Fed turned this market around here because it sort of let it be known that the Fed funds rate isn't going to be raised in March. So you have to be concerned. I am concerned about the high yield market. I think that's in a major bubble. But I won't say to short it tomorrow, even though we have a short position on it to some extent. But what we do is a very arcane kind of derivative where we do the CDS. We buy the CDS on it. I'm going to explain it on my Twitter account one of these days. I'm going to try to write something on it. It's really interesting what we do on that. But it would take you more than half an hour to get into what we do with these derivatives. It's really saying the credit spread is way too narrow. We did this in 2007. I did it in 2007 because I was worried. It was like this in 2007, and sometimes you hit big, and in 2007 and 2008, see, that's what happens. In 2008, on a couple of $100 million investment, believe it or not, we made $1.4 billion because the spread widens, and when it widens, you make a lot of money.
But does it worry you to be in the credit derivatives market in high yield at a time where there's a liquidity crunch? Can't everybody find the exit door? No,
that's why we're on the other side of it. In other words, if they can't find the door, we come out. Pretty good. We're out of the fire, so to speak. I really think it's a bubble, but I'm not going to tell you to get nervous today. I think with the Fed doing what they're doing, nobody can pick what the market's going to do tomorrow, next week, even next month, and maybe even 6 months. There are too many variables for the human brain to do it. It's wasted occupation. A lot of people write these erudite papers on it, but it's very hard to. You could pick it on a long-term basis and be right, or you could find a no-brainer. This is what I look for with the risk rewards.
You look for a no-brainer?
The risk rewards major in your favor. I think there's a no-brainer. Long-term, the high-yield market is in a bubble, but when it's going to burst, it costs you money to do what I'm saying. It costs you money while you're waiting. So it's not for a lot of people.